My name is Gina Smilik, and I'm an economics reporter at the New York Times. I'm here at the International Monetary Fund today to speak with Nan Lee, Deputy Division Chief of the Research Department, and Dia Noor-Eldin, an economist in the Research Department. We will be discussing Chapter 3 from the World Economic Outlook. The chapter is titled Slowdown in Global Medium-Term Growth, What Will It Take to Turn the Tide? And as you might guess, it digs into the factors that are likely to influence the global economy in the years ahead. The authors find that without timely policy changes, global growth is likely to run at just 2.8% by 2030, a full percentage point lower than what was normal in the roughly 2 decades leading up to the pandemic. The authors talk about how economies can better leverage labor and harness new technologies like artificial intelligence to brighten that otherwise lackluster outlook. Nan, Dia, thank you for taking the time to explain your work to me. Nan, maybe we could start with you giving an overview of what's in the chapter, what your headline findings are, and then we can dig in with some more specific questions.
Thank you, Gina. So we are looking at a global economy that has been slowing down since the 2008-2009 financial crisis. And our study shows by the end of the decade, global growth is likely to fall below 1 percentage point below the historical average. And this decline is more than just numbers. That means our living standard could worsen, and it poses important challenges for the poor countries to catch up with the richer ones. So behind this decline in GDP growth, what we see is a widespread and a significant decline in productivity growth. That is, how efficiently we are using capital and labor. It's responsible for more than half the decline in advanced economies in emerging markets and almost entirely for low-income countries. So what is the way forward, and what should policymakers do? In our analysis, we pinpointed a few actionable strategies, and the most important is that we need to in order to revive the growth, we need to prioritize productivity reforms, and that includes reforms that can move the labor and the capital to the most efficient use. And we find if we are ambitious enough, even though we can come up with ambitious but also achievable policy packages, that we can really bring our growth back to what we have seen in the past, especially if we also harness the new technologies.
Okay, interesting. And Dia, I wonder if you could talk a little bit about sort of what motivated this string of questions. Just walk me through why you did this research.
So I think a key motivation is that the growth outlook looking 5 years ahead after the current business cycle and all of this interest rate tightening is looking very weak. The IMF started compiling 5-year ahead forecasts back in 1990, and today we're seeing the weakest outlook since this record began. What's also concerning is that that doesn't reflect just the views of the economists in the IMF, but actually if you look at census economics forecasts, which surveys other international organizations, academic economists and the private sector, the trend is the same. It seems that 2008 was some kind of turning point for the dimming outlook. And as Nan said, that raises concerns.
Yeah, interesting. Nan, I guess I wonder if you could talk a little bit about why we should be concerned about that, because I think there are a lot of people who sort of look at Japan, for example, and say maybe growth isn't everything. Maybe you can have pretty good GDP per capita in a world where you don't necessarily need rapid growth every year. But I wonder why you think it's concerning that we're predicting this pretty concerted slowdown.
Yes, growth is really important for everyone, for private individuals as a consumer, for workers looking for jobs and looking to have a reasonable wage growth like what we have seen before, and also for businesses, right? If you know growth is going to slow down, what are you going to do? You're going to cut back investment, that including investment in your capital and also technology, and that affects people who are really forward-looking and making investment in their education and making innovation. So if you think growth is going to slow down, you're probably going to change a lot of your behavior. And I think very tangibly for a lot of us, the wage growth is going to slow down. That means imply your consumption will also slow down.
Yeah, and you make a really interesting point in the chapter about what this means for global convergence. I wonder if you could talk a little bit about that.
Right. So the global convergence is this idea that poor countries, as they are growing, they usually grow faster than the richer countries. So if you look at the correlation or relationship between the GDP growth and where they are at the GDP level, you will see a negative correlation, right? So the poor countries catching up, growing faster. And we saw this rapid convergence actually happened in the right before the global financial crisis, and then it slowed down. But then right before the pandemic, this convergence slowed down significantly, and now with this forecasted data, we are basically saying if we believe what we project is going to happen, then there is not going to be convergence anymore. The convergence will be either stalled or even diverged. And this is when we look at different measure of wealth. You can look at GDP per capita. You can look at even some kind of welfare measure that incorporate also life expectancy within country, consumption inequality, and also leisure. And all across the board, no matter how we look at this convergence pattern, is just going to stall, and that is really concerning for all of us.
What kind of countries would that pose challenges for potentially? Like, are there examples?
Yes, especially for low-income countries. You know, they are. We know in the past few decades there is a lot of poverty reduction. Living standard has been lifted for those poor countries, and if this convergence is going to stop, that means they're going to stuck in a relatively poor situation.
Yeah, interesting. And Dia, I wonder if you could walk us through a little bit of the history that brought us up to this point. You know, can you give me you do a nice job in the chapter of giving an overview of how we got here. And I wonder if you could talk about why that 2008 turning point happened.
Right. There I would like to structure the answer around three key forces. I mean, we think about output as the process by which we can transform inputs such as labor and capital into goods and services that we can purchase. So you have the labor inputs, you have the capital goods, and you also have the efficiency through which we can transform them into output. And this efficiency is a product of technology and also is a product of how efficient these resources are allocated into the economy. So to give a bird's eye view of what the main forces are, if you look at labor inputs, what we see is demographic pressures becoming a real drag on GDP growth globally. For the biggest advanced economies, actually almost all advanced economies, but also large emerging markets such as China. So this has been a force that's dragging down growth. Private investment, which is a key contributor of capital formation, has been anemic. Part of that could relate to the declining growth and the declining growth outlook, because that can be a little bit also self-fulfilling in the sense that if people expect that 5 years from today, GDP is not going to be growing as much, they may invest less today. And then the third important drag is on productivity. And there we can, again, separate it into the technological frontier through which all economies are operating, and some of the middle-income, lower-income economies are trying to catch up. But also equally importantly is the allocation of resources. And what we find is that there's been increasing misallocation of labor and capital across firms. And this is happening primarily because there are structural factors in these economies that are preventing labor to move from the lower productivity firms to the higher productivity firms. So I would say that's the broader overview, but inside each of these parameters we can dig deeper, of course.
Yeah, absolutely. I mean, I wonder if it might be interesting, I'll stick with you for a minute. I wonder if it might be interesting to talk a little bit about some of those demographic factors you were talking about. You know, can you unpack that a little bit for me? Like, what are the challenges countries face when it comes to these demographic issues?
Sure. So I think the first message I would like to start with is that the working age population in the world, that's people aged between 15 to 64, has been slowing down in around 92% of the global economy and shrinking in 44%. These numbers are striking, right? And here I'm comparing since 2008. So typically we think about the global financial crisis in terms of labor market scarring and investments going down, but actually it was a demographic turning point for the largest economies. And that means that aging is a force that's going to create labor shortages in some parts of the world. Now, there is heterogeneity in this picture because there are some countries that are going to see their working age populations grow, mostly lower income countries. And that creates an interesting picture globally of an imbalance in the labor supply. If you look to the West and to the north, you would see labor shortages and labor squeeze. But if you look to the east and look to the south, then you would see more expansion. And that gives us, again, a sense of how this is going to play out in the near term. This is the first dimension. The second dimension and the second message is that aging is also taking a toll on labor force participation. And we economists talk about participation as the willingness of everyone in the economy at working age to be engaged either by being in a job or looking for a job actively. And there, the striking change is, as the demographic pyramid changes because of aging, two numbers stand out, 80 and 20. And 80 is the labor force participation rate of those in prime working age, 25 to 54. 20 is the participation rate of those above 65 who chose to be voluntarily working beyond retirement. Now, if these two numbers stay the same, the aggregate participation rate is going to come down because you are moving the population bulk from one group to the other over time. So that gives us a drag on labor force participation. Today we see it, and it's going to intensify in the future.
Yeah, that's an interesting point. And we will come back to demographics when we get to solutions. But I wonder if, Nana, if you would unpack for me a little bit the productivity part of your finding. And in particular, I wonder if you could define for our listeners allocative efficiency, because I think it's maybe not the most intuitive concept.
Right. So starting from what Dia was saying, what we saw is all three components. That is the capital, which is like machinery and equipment, and the labor and the productivity. But all of them have coming down in terms of their growth rates, but the bulk of it is driven by the productivity growth slowing down. And let me unpack the productivity growth. We usually, generally speaking, there are two sources of TFP growth. TFP, total factor productivity, that is how efficient you are using capital and the labor. The first one is well known, and most people have heard about it. It's related to innovation. So that is, you want to do things better, you want to have a new product, or you want to make a be more efficient in making certain things. And that is often tied to technology progress or innovation in your practice and business practices. That growth of that innovation rate has come down. And there are many studies have shown that, and that is something we have known, and that is usually related to the observation that it's increasingly hard to find breakthrough technologies, radical technologies. A lot of technology has been just incremental innovation. So let me put a pause on that, because that has been known. Now, what this chapter did that is more novel is that we also uncover another source of productivity growth slowdown, which is what we call allocative efficiency. It just means, allocative efficiency just means how well the capital and the labor in the economy is distributed across firms, how well that distribution reflects the productivity of the firm. So put it simply, if you think about there are two firms in the economy, one can use the existing, money, employment, employer, and other resources to produce something faster and more profitable when the other one is struggling to do so. But if over time resources are flowing into that less productive firm, then over time, as aggregate economy, you will see efficiency coming down. And that is the case for decreasing allocative efficiency.
That makes a lot of sense. And why would that happen? Like, why would resources flow into a less productive firm?
Yes, that's a very good question. So there are many sources and the causes for what we call misallocation, basically just resources flowing to less productive firms. Some of them are structural and policy related, and some of them are just more natural part of the adjustment process. So for example, regulation. In some countries, you have this strict regulation make it really hard for companies or individuals have great ideas to enter the new markets, or you have regulation that prevent company from hiring and firing worker easily. So that become a friction when a company supposedly discover a new idea and would like to attract worker because cannot find worker easily, would not also attract worker. So this adjustment process become very slow, and that is the case for misallocation. And you can also have a situation, it's just there's no enough information, so there is what we call asymmetric information, market failure, so people just don't know about those opportunities, so the resources are not allocated properly. And in a lot of cases, what we see is related to institution, like whether the governance, right? You have, in cases, companies have political connection or corruption, give certain company unjustified advantages in terms of tax credits or direct projects or cheaper credit. That allow those firms to stay afloat even though they are not supposed to. So when you see the misallocation is worsening, sometimes it's related to the fact that there is some adjustment needs to be happening in the economy, but because of this barrier is there, that adjustment becomes slower.
Yeah, that's really interesting. And why, one thing that I thought was really interesting in the report is that the U.S. is an exception to this decline in allocative efficiency and TFP growth. And I wonder if you could talk a little bit about why you think that might be.
Sure. It is true, to our amaze also, U.S. really stand out in that sense. But when you look at, so we are studying this 20-year period before pandemic from 2000 to 2019. So before the global financial crisis, U.S. and other advanced economies are following similar trend in the sense that misallocation is becoming higher. But then U.S. seems to reverse this misallocation trend after the global financial crisis. And what is happening is, if you look at indicators such as the flexibility of labor markets, or regulation of the product market, or access to finance, right? So those are the indicators about the institution and the policies. U.S. is really much better than the other advanced economies. So in that sense, if you have particularly technologies that affect certain firms and that require some kind of adjustment of resources in the economy, in U.S. this adjustment is just happening much faster, even though at the beginning it does go through this increasing misallocation because adjustment just takes a long time. But over time, it corrects itself much faster. So really the conclusion coming out of there is that if you want to, respond better to future shocks or just increase the allocative efficiency overall, you need to reduce those frictions, the frictions that prevent the capital and labor move to the most productive firms.
Yeah, that absolutely makes sense. So we're moving kind of towards solutions. But before we get into the labor market solutions, I wanted to ask a little bit more about where we've seen sort of the drop-off in participation in particular, or where we're seeing sort of the losses in potential workers. Because you have a really interesting chart in here. I wonder if you could maybe explain it to us.
Sure. Thank you for bringing this up, because there is, as you mentioned, a lot of heterogeneity across the world. Although the world has lost around 2 percentage points in participation between 2008 and 2021, this really masks a lot of heterogeneity across regions. And what we see a lot of the aging effects basically concentrated in advanced economies and in China. China actually resembles advanced economies in that dimension. The only difference is that most of the advanced economies, with the exception of the US, have managed to counter this aging effect by enhancing the participation of women in the labor force. There have been impressive gains in Japan, for instance. I know you have written about this. Impressive gains in other advanced Asian economies and also in Europe. Not so much in the US, where we stopped with the latest data point, but I know that there's been some hope for and evidence of progress more recently. So if you look at other emerging markets, there's still perhaps not so much from a drag from aging, but for some reason labor force participation for men have been coming down. It has been a drag in some of the emerging markets. We did not really explore in the report why this is happening, but let's also remember that the participation of men already starts from a very high number, around 90% globally versus 70% for females. So another way to say that is that there was room for gains and impressive improvements for women. So I would say for the US in particular also, I think the gains are yet to be seen in the more recent data points. So that's where the divergence is happening. The aging effect has been positive in sub-Saharan Africa, for instance, so has been a positive force, but again, there's been a retraction in participation for men and women, and that could be because of the nature of the labor markets in these economies.
That's interesting. That's interesting. And then, so obviously a lot going on, a lot of uncertainty about how this all plays out going forward. There are also obviously some uncertainties in other parts of the economy when it comes to this potential for growth. I wonder if one of you, and whoever wants to take this one, I wonder if one of you could talk a little bit about what we know about AI's potential to change the trajectory here.
Right. I think I'm happy to start, and then I can also jump in. So we actually, one of the scenarios that we consider in the chapter is we basically we look at the up until the year 2030, and we have a baseline scenario, as you mentioned in the introduction, where growth is 2.8%, 1 percentage point below historical average. And we think about the role for different policies and technologies, perhaps, that can enable us to revive growth and close this gap. One of them is AI, and there's a lot of interest in the potential impacts of AI. The first point I want to make there is that our estimates show that AI can add to growth annually by between 0.1 and 0.8 percentage points. If you take the upper range there, it's significant. It's 80% of the gap we hope to close, right? But there's also a large range for the impacts. There's a lot of uncertainty, and the uncertainty comes from the fact that AI has as an emerging technology, has the nature that it can not only substitute jobs, but it can also complement jobs. And to give you an example of that, think, for instance, about a research assistant working on one of the WEO chapters, right? Part of their job is to parse through a lot of data, a lot of reports, and try to summarize them. Now, this task can be efficiently executed by AI in the very near future. But also the consequence of error there is not so substantial, so there's potential for substitution in that case. On the other hand, think of a judge. And again, in her day-to-day job, she has to go through a lot of documents that can be efficiently summarized by AI, but I think the economy and the society would see that there's the room for error there, or if there's error, it will have grave consequences. So there, we see AI as potentially complementing the job of the judge, making her more efficient at going through more and more cases in a given period of time. And the nature of how this is going to play out, how it's going to ripple through in the coming years, is an unknown. We don't know how much displacement versus complementarity is going to take place. And that's why the range of estimates is large. But the second message I want to say, and there we have a little bit of more certainty about the outcome that we are going to see, is that more likely than not, it will increase inequalities within countries and also across countries. And we learned that because we run simulations under different plausible assumptions, and the majority of outcomes we see inequality worsening. And the reason is that AI is likely to reward those with higher skills. Think of STEM graduates who may already be in jobs that can very much benefit from the complementarity of AI at the expense of the lower end of the spectrum. That's within economies. If you scale that across economies, you also have a big digital divide. A lot of the low-income and middle-income countries do not have the digital infrastructure to fully harness the impact of this wave. So in one of the scenarios we run as well, we see that inequality is likely to be on the rise globally, or the room for convergence, the window is really, really closing. The third point I want to make, and eventually I think we'll get into policies, is that policymakers have tools at their disposal to counter some of these negative impacts.
Yeah, absolutely. And then I guess another external factor that I was hoping to ask you about that I think is really interesting that you bring up in the report is the role of large government debts in sort of, the growth trajectory and the outlook. And I wonder if you could walk me through a little bit why you bring those up, why they matter in this scenario.
Yes, this is one of the big headwinds we analyze in our scenario analysis. So what we saw is associated with a lot of fiscal stimulus during the pandemic, there have been built up of this government debt, and that is quite widespread in advanced economy and low-income countries with or without resources at the time. And this debt has been staying high, and a lot of projection we have seen and we made internally also project that that is not going to come down. So why it could be costly for growth? Because first of all, all countries would like to stabilize the debt for many reasons. And when you're stabilizing the debt, you need to have the resources to pay the interest payments. Then how do you draw in resources? You can draw resources by cutting down expenditure. A lot of those expenditure actually go into productive purposes like education or infrastructure, or you raise your tax rate, and that can be also can be negative, have negative impact on growth. So we analyze different scenarios, either assuming that it's going to stabilize or that it's going to come down in the medium term, and that will give us between 15 to about 50 basis points extra cut to medium-term growth. And of course, that is not even considering a very strong fiscal consolidation, which could be have even more adverse impact on growth.
Oh, that's interesting. And so basically trying to get rid of these deficits or these debt loads is going to have a negative
right.
impact
So
on growth.
that means how do you pace this fiscal consolidation will be very important. You want it to be gradual, but moving towards the right direction. You need to put in a good medium-term framework, knowing where you are going, and not to do too much in the short term, and it will be detrimental for growth.
Yeah, that absolutely makes sense. And then finally, and I'm going to do one more risk to growth, and then we'll move on to some solutions in the optimistic portion of today's programming. But you talk in the report about fragmentation and how that is potentially important here. And I wonder, we're obviously, it's IMF World Bank meetings. I'm sure we'll be hearing the word friendshoring until we're all green in the face this week. I wonder how these fragmentation, the move towards fragmentation, how that factors into the picture here.
Right. So let's first define what the geoeconomic fragmentation means. I think broadly we just mean the policy-driven reversal of global economic integration. And in the data, what you find is, since the start of the Russian invasion in Ukraine, there are a lot of new trade restrictions increasing. I think there are statistics about in 2030 there's 3,000 new trade restrictions. That is like tripling the level in 2019. So countries are doing this for all kinds of reasons. A lot of are well justified for social security and resilience. But the reality is the politically instant blocks, they just trade much less than within the bloc. So between the bloc, they trade much less than within the bloc. And so in our report, we think this will have some potential implication for efficiency loss. And we simulate different scenarios. It ranges from a limited fragmentation scenario where you have a US bloc and a China bloc engage in some friendshoring, and to a more extensive fragmentation scenario where everyone do some reshoring, so they're cutting down trade with each other. So the impact we estimate just through this trade in goods and services and investment capital is about 10 to 80 basis points lower than the baseline growth. And this hasn't factored in, the potential big impact on exchange of ideas, which could give even higher impact on dragging down growth.
Oh, that's an interesting point. So we've talked about a lot of risks to potential growth. I wonder if we could talk about some of the potential solutions, what you think could be done in order to make sure that this sort of lackluster growth picture doesn't come to pass. And maybe it makes sense to start with the labor market. I wonder, are there things countries can be doing to try and leverage the labor they do have available, or to make sure that they have greater flows of labor available?
Right. So I think one point to start with is labor force participation, because as I mentioned, we have further room to enhance the participation of women labor force. In advanced economies, we can still close the gap with men, but actually, if you look at emerging markets and low-income countries, there's a huge gap. There's a huge pool of untapped labor resources there that is currently not fully utilized in terms of potential. So I think that's one area where we have studied how reforms can help. There's also the potential to increase the labor force participation of older workers, because some of us can choose to go to retirement before the statutory age, right? And some of us even choose to work beyond that. So we thought about the kind of policies that encourage workers to remain active in the labor force. And the scenario that we ran, we basically looked at the variation of policies and outcomes across a group of economies and asked a simple question: what happens if you improve policies up to a particular level, such that all of these countries converge to that level. And that gives us, as a median estimate across these countries, around 3.2 percentage points increase in labor force participation. This is a decent number. But when you translate that into the impact on growth by 2030, you see it giving you less than 0.2 percentage points. And that's, again, because the fact that you have also the working age population growth slowing down, and the contribution of labor to capital is only a certain share, right? Because you have capital and technologies. That's one way we are saying that can help, but it will not close all the gap. And that's why we provided this scenario, just to give a glimpse of what you can achieve with these kind of policies. So we encourage policymakers to think about them. We think they can help, and they can help in some countries more than others. The second scenario that we run is considering migration flows, because, as I mentioned, you have this global imbalance of the labor supply, and we know that migration has historically supported growth in advanced economies quite strongly, and we see a lot of evidence for that more recently in the US and major advanced economies. And the scenario that we considered there is to think about an increase of the labor force by 2030 in advanced economies by around 1 percentage point. And there, it's going to be around, think of 5.5 million more workers flowing from lower income countries to higher income countries. And that can give you, again, a little bit of a boost to growth. And we assume that they're going to be integrating efficiently also in the labor market. And that's a very important point for migrants. We want to see them integrating in the societies, getting high paid jobs, their skills fully recognized, and they can participate productively in the labor market. If you combine these two sets of policies, that gives you around 0.4 percentage points, 40% of the gap. That's why we emphasize in the report that there are other policies that may hold also more promise, and Nan will talk more about productivity enhancing policies, but this is not to mean that we should not think about that. I think everything is going to help. Every little intervention is going to help.
Yeah. You kind of stole my thunder there, but could we talk a little bit about...
But in fact, before I move to productivity reform, I actually want to add a bit to what Dia has mentioned. I think this is, it's not just about getting people into the labor force, luring them into labor force, but also about allocation of talents, yes. Right? And this is an area I have personally passionate about, and we are actively engaged in a lot of research. Let me be more clear what it means. So we know in advanced economies, the gap between the jobs and earning between men and women has been shrinking, even though it's still not perfect. But there's still a wide gap in emerging market and developing countries. And just imagine if you move towards a correct direction where you can open up the pool of talent to include women and minorities, and how much productivity you can actually tap in. And just to give some examples, there are studies looking at the US experience. I think in 1960s, it's about 94% of the jobs, like doctors or lawyers, are taken by white men, and in 2010 the number comes down to 64%. So there are studies showing if how much they are trying to understand how much of this change in the talent allocation or better improvement of talent allocation has contributed to U.S. production, U.S. GDP growth, and they find it's about 20 to 40% of growth was actually accounted by a better allocation of talent. And imagine if across the world, in all countries, people, the jobs are filled because this person is a better fit or has the better skill, not because of some social norm or discrimination. Then we could potentially, according to our analysis, we can boost the global growth by another 0.25%. And this is a small, I think it's a lower bound for that estimate, because at the beginning when the gap is wide, in the medium term we could even reap bigger benefits. So I think that is another unstudied and unexplored area we should pay more attention to.
Okay, interesting. And when it comes to, and after this we'll wrap up, but when it comes to productivity in particular, because you guys obviously you find that it's just such a huge portion of what has happened to this growth trajectory, like what can be done to improve the productivity chances of the economy?
Right. this is a very important area. It's an area, according to our analysis, quantitatively will contribute the most if you do it right. What we did is when we look at different policy areas that is related to labor market flexibility, product market flexibility, access to finance, or trade openness, we say if all countries close the gap with US by just 15%, that will significantly boost productivity. And because productivity also matters for capital, so altogether it will contribute to global growth by itself is enough to bring the growth back to the level we saw historically. And let me just be more, give some example of what those reforms are like. For example, you can reduce those regulations that make firms doing business harder. You can streamline the process for start a business. You can trying to extend financial access to small and medium-sized firms that have good ideas and the potential to grow. You can remove those size-dependent regulations in some countries. If you are a firm of size 10 people and above, you have to pay tax, otherwise you do not pay tax, then the small firm will continue to be small and they cannot grow. So those are kind of the distortions we're talking about that actually prevent the economy from growing. And since we saw those as so pervasive, this is the area that we think the policy can have the most power.
Okay, interesting. And just very quickly, I wonder if each of you could just give me sort of a 20-second overview of what you think the most important takeaways from this research are. And Nan, maybe I'll start with you.
Sure. I would say it's time we need to really step up our reform efforts to revive growth and particularly do more in the structural areas. Otherwise, our living standard will be worsened or stagnate in the medium term.
Okay. And Dia?
For me, I think the main takeaway is that, yes, there's a dimming outlook, but there is a lot of hope. But this is conditional on policy action and structural reforms. And there is a sense of urgency to that. And we hope that we see the kind of reforms that can really revive growth to historical standards.
Okay, interesting. Well, thank you both. Dia Norelden, Nan Lee, thank you for taking the time to walk us through your chapter. Very pessimistic originally, but we ended it on an optimistic note, so that's good. Very interesting research. We really appreciate your time.
Thank you so
Gina.
much, Gina.
Thank you.